Good morning, everyone. My name is Bisay, and today I will be presenting about a real-world case that apply with the principle of the time value of money, or we can call it TVM, to a personal finance decision making. The case study for today will be examining whether it's better to use $10,000 to pay off a loan or invest it in a bond fund. Let's dive into it. And for the problem statement for today, it's about using the $10,000 principal with the 5% annual interest or investment option with the bond fund with a 7% annual return. So the question is, should we invest it or keep it up with the $10,000 to be used to pay off the loan? And now let's look at the objective that we're going through to solve this problem. We have three objectives, which is the first one, calculate how much the loan will cost after 5 years if it not repaid now. Second is calculate how much the $10,000 investment will grow in 5 years. And the third objective, which is comparing the two options to decide which one is better. So by the end of this presentation, we'll have a clear answer to our question. So first, understanding the loan cost. If you don't pay off the loan now, it will keep growing because of the interest of 5% per year after 5 years. And we want to calculate how much the loan will cost after 5 years and if you don't repay it today. And secondly is understand the investment growth of the $10,000 instead with the growth of 7% annual return. And we want to calculate how much money you will have from this investment after 5 years. So with these two options, we can know the benefit of which one is better. Because of that, we have the assumption with the condition and the rule to make the calculation simple and fair. We make a few assumptions, which is the loan has 5% of annual interest rate compounded yearly, and the investment offer a 7% annual return, also compounded yearly. The $10,000 is available to use immediately with no penalties for delaying the loan repayment. And finally, we assume the investment is safe and risk-free, although real investment might carry some risk. Now let's look at the math which of the option 1 and the option 2. The option 1, which is the loan repayment. So if the loan isn't paid now, it will grow by 5% interest each year. So after 5 years, the loan will cost with the formulation of the time value of money, we will earn $12,762.82. But with the option 2, which is the investment with the 7% annual return, if the $10,000 is invested instead, it will grow by 7% annual return. So after 5 years, the investment will be worth with the time value of money. So the money will be $14,022.52. And after comparing these two, the investment grew by 1,262.7 more than the loan cost over 5 years. This is the graph that clearly shows the difference between the two options. The loan cost after 5 years is $12,762.82, but the investment value after 5 years is $14,025.52. So the investing gives a higher return, making it better choice in this case. So after this, you can make your own decision, and this is clearly our recommendation. With the invest of the $10,000 instead of paying off the loan. This option let your money grow faster, giving you an extra $1,262.7 after 5 years. However, before you making the decision, considering the factor like the risk, the reinvestment might not give you the guarantee of the 7% of return. So some company or some bank company will not give you the 7% of the annual return, but you can choose which company that you want to invest it with the high percentage of the return. So the penalty target is check if there are an extra fee for delaying the loan repayment. So in conclusion, we use TVM to compare the two options for the $10,000 and paying off the loan would sell you 12,762.82 after 5 years, but the investing is better because it gives you more money with the 14,025.52 dollars. So the investment provide a better outcome with 1,262.7 more. So in this case, it shows how understanding the time value of money can help us to make a smarter decision making in your personal financial decision. And this is the references of the analysis that including the financial textbook and online resources that help us to calculate the time value of money and applying it to the real world problem. And this is the end of my presentation. And thank you for listening. And if you have any question, you can comment it down below.